As the year draws to a close, the relentless energy of Wall Street gradually gives way to a softer, more contemplative atmosphere. The usual clamor of ringing bells and rapid-fire trades is replaced by a gentle hum, as if the entire financial district is taking a collective breath. Traders refer to this period as holiday mode, a time when the pace slows and the focus subtly shifts from the immediate to the introspective. The air is tinged with a sense of reflection as professionals take stock of the year's wins and losses. The week between Christmas and New Year's is especially unique. Trading volumes drop to some of their lowest levels of the year, and only a skeleton crew remains on the floor. With fewer hands on deck, every trade seems to carry a little more weight, and even small moves can ripple through the market. With many major players and institutional investors away on vacation, the market tends to drift quietly, often with a gentle upward bias as optimism for the new year quietly builds. But this lull is far from inactivity. Instead, it's a strategic pause, a moment for investors to review their portfolios, analyze year-end reports, and consider adjustments for the months ahead. Analysts remain vigilant, scanning for subtle shifts in sentiment or unexpected news that could set the tone for January's opening trades. Even in the quiet, opportunities and risks are quietly assessed. The holiday slowdown isn't about dramatic swings or headline-making moves. Instead, it's a time for quiet positioning, careful planning, and setting the stage for the year to come. For many on Wall Street, these quieter days offer a rare chance to step back, reflect on strategies, reassess risk, and prepare for the challenges and opportunities that the new year will inevitably bring. The gentle hum of Wall Street during the holidays isn't a sign of rest. It's a signal of readiness, as the financial world quietly gears up for whatever comes next. Enter the Santa Claus Rally, a well-known market phenomenon that captures the imagination of investors and analysts every winter. This unique event is named after the jolly figure himself, but its impact on the financial world is anything but make-believe. The Santa Claus Rally refers to the tendency for stocks to climb during the last 5 trading days of December and the first 2 trading days of January. During this brief window, markets often experience a noticeable uptick, with many investors eagerly anticipating the potential gains. This pattern, tracked for decades, is more than just holiday cheer. It's seen as a barometer for the market's health. Analysts pore over historical data, searching for clues about what the rally, or its absence, might mean for the coming year. If the rally fails to appear, some see it as a warning sign for the year ahead. The causes? Holiday optimism, a general sense of hopefulness, and the belief that the new year will bring fresh opportunities. Year-end bonuses flowing into stocks also play a role, as many people invest their extra cash before the year closes, hoping to maximize returns and take advantage of tax benefits. And with many institutional traders away on holiday, retail investors often have a bigger influence on the market, leading to lighter trading volumes and sometimes more pronounced price swings. The rally's presence boosts confidence, reinforcing positive sentiment as the year turns. It's a time when hope and excitement can drive markets higher, even if just for a short while. It's a blend of psychology, tradition, and market mechanics, where optimism often outweighs caution. The Santa Claus Rally is a reminder of how emotions and expectations can shape financial outcomes. Investors watch closely, hoping this festive surge sets a hopeful tone for the new year. For many, it's a chance to start January on a positive note, with renewed enthusiasm for what lies ahead. The Santa Claus Rally is more than a gift. It's a signal of the market's mood as the calendar flips, and a tradition that continues to intrigue and inspire market watchers every holiday season. After a strong run, the market naturally slows as the year winds down. This is classic holiday trading. The energy that usually pulses through the trading floor fades, replaced by a sense of anticipation and reflection. For many, this is a rare moment to pause and look back at the year's ups and downs, and to consider what lies ahead. With traders and fund managers on break, trading volume drops, and the market drifts on little news. The usual buzz of activity is replaced by a quiet hum. as only a skeleton crew remains to monitor the screens. Headlines slow to a trickle, and price movements are often driven more by technical factors than by fresh information. This week, shortened by the New Year's holiday, is especially quiet, with thin trading amplifying even small moves. Even minor trades can cause outsized swings, making the market feel unpredictable despite the overall calm. For those still at their desks, it's a time to watch for unexpected opportunities or risks that can emerge in a low-volume environment. While the overall market seems sleepy, individual stocks can still see volatility due to low liquidity. A single large order can send prices jumping, catching some off guard. This is a period where caution and patience are rewarded, as sudden moves can be misleading. Most investors shift focus from short-term trades to long-term positioning, setting up for the new year. It's a chance to review strategies, rebalance portfolios, and set new financial goals. Many use this time to reflect on lessons learned and to plan for the opportunities and challenges that January may bring. The calm is a necessary reset, letting the market digest gains and prepare for January's renewed activity. It's a collective exhale after months of intensity, giving both markets and participants a chance to recharge before the action picks up again. It's a deceptive quiet. Underneath, portfolios are being adjusted for what's next. Advisors and investors are quietly making moves, positioning themselves for the first big headlines and earnings reports of the new year. The strong finish last week sets a positive tone, but now Wall Street takes a collective breath. The festive atmosphere masks the underlying readiness for what's to come, as everyone waits for the first signals of the new year's direction. This lull is the calm before the storm of new data and earnings that will kick off the year. Soon, the quiet will give way to renewed energy as traders and investors return, ready to respond to the next wave of news and market moves. To understand today's calm, look back at last week's surge. Wall Street ended the year with a bang. The S&P 500 hit a record high, signaling strong investor confidence and broad market strength. Tech giants led the charge, rebounding from earlier setbacks and reminding everyone of their economic power. This wasn't a one-off. It capped weeks of growing optimism and sustained gains. The rally was broad-based, lifting spirits and portfolios across sectors. Hitting a record high before the holidays adds psychological comfort, reinforcing faith in the recovery. Last week's performance is more than a number. It's a symbol of resilience and hope for 2026. Investors now enter the new year with momentum and a sense of accomplishment. Last week's rally was powered by the tech sector, big cap giants in software, hardware, and internet services. As inflation fears eased, investors returned to tech, betting on long-term growth and innovation. These companies, with strong balance sheets and global reach, are seen as the safest bets in a stabilizing economy. The excitement wasn't just about tech in general, it was about the explosive potential of artificial intelligence. AI leaders saw their stocks soar, fueling the market's momentum. The tech rebound signals renewed faith in innovation as the engine of wealth creation. As 2026 approaches, all eyes remain on these titans to drive the next chapter of growth. At the heart of tech's resurgence is artificial intelligence, a transformative force reshaping industries. Investors see AI as the biggest opportunity since the internet, driving money into companies leading this revolution. AI promises new efficiencies and markets, from healthcare to finance to entertainment. The belief in AI's long-term impact encourages investors to look past short-term volatility and hold for the future. Recent tech rallies reaffirm this thesis. It's not just about earnings, but about the promise of AI-driven change. The market's optimism is fueled by the expectation that AI will unlock massive value in the years ahead. As 2026 begins, AI's progress will remain a top story, shaping strategies and market dynamics. The narrative of AI is now a powerful tailwind for Wall Street. Beyond tech, the Federal Reserve's actions remain the market's biggest influence. After years of rate hikes to fight inflation, investors now expect the Fed to pause and eventually cut rates. Cooling inflation data supports this view, fueling optimism and risk-taking in the market. Every economic report is scrutinized for clues about the timing of the first rate cut. The prospect of easier monetary policy is a major tailwind for stocks, especially in growth sectors. The Fed's next move is the market's central question, with billions riding on the answer. For now, Wall Street is betting the era of high rates is ending, setting a positive tone for 2026. The Fed's decisions will continue to dominate headlines and drive market direction in the year ahead. Interest rates shape everything on Wall Street. High rates make borrowing costly and bonds attractive, pulling money from stocks. When rates fall, borrowing is cheaper, fueling growth and making stocks more appealing. Recent signs of cooling inflation have investors betting on Fed rate cuts in 2026. Lower rates especially boost growth sectors like tech, where future earnings become more valuable. This expectation is driving the current optimism, even in the quiet holiday market. Investors are positioning for a friendlier environment, hoping for a strong start to the new year. The prospect of rate cuts is a light at the end of the tunnel, keeping sentiment resilient. As the year turns, hope for easier financial conditions is the market's main motivator. As the new year approaches, Wall Street's mood is quietly optimistic. The holiday calm masks a market that's confident after overcoming inflation and hitting record highs. Optimism is built on two pillars: the expectation of Fed rate cuts and the transformative promise of AI. While uncertainty remains, the outlook for 2026 is positive. Investors see easier financial conditions and accelerating innovation. The recent rally and strong finish set a hopeful stage for the year ahead. The holiday slowdown is just a pause before the action resumes. For many, the Santa Claus rally has delivered, and anticipation for 2026 is high. Investors are ready, hoping the new year brings more positive returns.